welcome to Money Talks. I'm Peter Switzer, and this is a special episode of Money Talks, which I've called the property punch-up of the century. In one corner, we have John Adams, Chief Economist at As Good as Gold Australia, and he's someone who's concerned about Australia's level of debt and how it could cause big falls in house prices, among other things. In the other corner is Christopher Joye, who's a former RBA economist, founder of Coolaway Capital Investments, where he manages his bond fund, and he also writes for the AFR. This is a debate to see how scared we should be about our debt levels and what they could do to house prices and the economy. John will kick off with these worrying scenarios that are linked both to debt and the implications on house prices, where some colleagues, where he has some agreement, have talked about 40, 50% house price falls. John, take it away.
Thank you, Peter. Thanks, Chris, for coming tonight.
Thank you.
So my whole what I've been doing publicly for about 4 years is talking about the quantum of debt in the economy. So we had an admission from the Reserve Bank of Australia in 2007 that the amount of credit in the economy at that point was bigger than the 1880s and the 1920s. And why is that significant? Because we had a depression in 1892, we had a depression in 1931. So RBA says 2007, the debt was bigger than those periods. Well, today, the debt is substantially larger than 2007. So the level of household debt, but also you look at the foreign debt, which is about 56, 57% of GDP, it is the most we've ever had since the first fleet.
So this is government and private debt, all linked to foreign debt?
Yes. So net foreign debt is over $1 trillion, and gross foreign debt is about $2.3 trillion. This is the biggest amount of domestic level of debt we've ever had, both in nominal terms but in proportional terms as well.
Okay.
But also we have global debt, 80 trillion more than 2007, about $250 billion, $250 trillion, about 300% of GDP.
Okay, John, can you explain the link? Because my view is, can hear the debt thing. What's the link then between debt, the economy, recession, house prices? Sure.
Okay, so the question is, if we've got the biggest debt bubble in the history of the country, where's the debt? The debt is in property. There's debt bubbles right across the world, and in different economies that's situated in different areas. So the debt bubble is in the housing sector. And what I've argued is, so I've written several columns about economic Armageddon. Armageddon comes when the debt represents a systemic crisis to the Australian economy. So there's a number of scenarios I've written about, and some of them revolve around if we default on the debt. So, for example, if households can't pay their debts and the banks get in trouble, this could lead to extremely sharp falls on property from 40 to 80%, depending if the banks survive. If the banks survive. No, there are scenarios, just like in 1892, when the banks did not survive, the level of house price falls is even more extreme than, say, Martin North. But if the Reserve Bank, if APRA, if the government steps in with macro intervention, then the question is, well, they could stabilise house prices, and that potentially could be, the falls could be lower than some of the more extreme forecasts, but that comes at a cost. And the cost is the value of the dollar, given the amount of foreign debt we have, because once our international creditors lose confidence in our ability to meet the foreign debt, the dollar, the dollar will crash. So effectively what I'm saying is Armageddon is either, for Australia, a housing crash or a dollar crash. But we can't get out of this problem because the amount of debt in the economy is unparalleled in Australian history.
Okay, Chris, you've heard his kick-off arguments. How do you want to respond? Do you want to say your story first, or you want to respond to
what? I'll just kind of respond to John's comments.
Okay.
I haven't read his material before. This is the first time we've met. Yeah. But a few points, and maybe we could bring up the chart as well.
Okay.
That I've provided you with. But I guess the first point that I think John misses is it's not just about debt. It's about the serviceability of that debt. It's about incomes and interest rates, right? And this is a crucial point, and it's why folks like John, experts in search of a headline, have been relentlessly wrong over the last couple of decades in relation to Australia. And we saw Steve Keen in the GFC, and I debated him in 2008. He said house prices were going to fall by 40%. I said they'd fall 5 to 10%. Right, they fell 8%. Jeremy Grantham from GMO came out in 2010.
One of the smart guys of the investment world.
Came out in 2010, said the Aussie housing bubble was the biggest in history. I bet him $100 million against against the CoreLogic Index for a 3-year trade from November 2010 to 2013. If he'd taken that trade, of course he didn't put his money where his mouth was, he would have had to have paid me $4.1 million, right? House prices appreciated over that
Now
period.
your chart's up now.
And this is the key point. So John has completely overlooked, he hasn't referred to at all incomes or interest rates. Now what we're seeing on this chart, it's actually a chart prepared by Dr. Alex Joye, who's Chief Economist of Industry Funds Management Investors. And what this shows is median house prices, which is the red line, from 1980, the red line from 1980 to 2018. And the red dotted line is just the median house price in 1980, grossed up or indexed against household income growth, one, and secondly, the change in borrowing capacity as a result of changing mortgage rates.
Okay.
And what this shows us is that you can see the red dotted line tracks the red line.
Yes.
And Aussie house prices over the last 40 years can be completely explained by household income growth and the huge reduction in mortgage rates. Now, what John didn't mention was the average mortgage rate in Australia between 1980 and 1995 was about 12.5%. The average mortgage rate since 1995 has been about 6%. So lo and behold...
Explain to my audience what mortgage rate means.
Well, home loan rate. It's pretty straightforward.
Yeah, okay,
yeah. So when the average home loan rate halves structurally from 12.5% between 1980 and 1995 to 6% from 1995 through to the current day, you get a big increase in household debt that's serviceable, right? And what this shows actually is that house prices today, according to this analysis, so if we take the 1980 price and gross it up by incomes and interest rates, it's actually about 3% cheap, right? Now that is predicated on
3% cheap compared to
the theoretical fair value,
okay,
right? Now that assumes that the RBA's cash rate stays at 1.5%. Now I personally don't think it will. If you think the RBA's cash rate is going to go to say 2.5%, house prices today are about 3% expensive. If you think it's going to go to 3%, they're about 8% expensive. Now, I called the boom correctly, as documented in my AFR column, between 2013 and 2017. We got the boom relentlessly right every single year. Strong double-digit house price growth. In April 2017, I said the boom's over, house prices are going to fall 5 to 10%. Nationally, they're now off 9%. A year later, I upgraded our forecast because it became clear that Labor would likely win the election. Remove negative gearing and increase capital gains tax by 50%. And so we upgraded our forecast to a 10 to 15% drawdown. So they're down 9%. If you ignore interest rates and only look at incomes, house prices look about 13% overvalued. So that could come through a 6% fall in house prices and it could come through a couple of years worth of wages growth. But I don't think there's any compelling case at all that there's going to be this cataclysmic 40 to 80% drawdown in house prices. And unfortunately for John, he will be proven relentlessly wrong like the other experts.
Okay, John, this is your turn to come back now.
Well, hang on. So I just want you, Chris, on the record. Do we have a house debt bubble in this country? Do we have a debt bubble or there is no debt bubble?
I've argued, I'll answer your question. I've argued that the levels of household debt have been excessively high. I've argued that consistently. I don't think we necessarily have a debt bubble. The measure. Wait a second, let me respond to your question.
I just got to make this point. 2007, the RBA on the record, the amount of debt at that point bigger than the 1880s, 1920s. The debt today has never been as big since 1788.
Buddy, the home ownership rate in Australia today is 70%. The home ownership rate in the 1890s was about 30%. That's a completely different economy.
No, but that's completely different. We are talking about debt and the serviceability of that debt. Now, it's serviceable now because the debt hasn't become a systemic issue. But you show me...
So why will it become a systemic issue if mortgage repayments as a share of income are actually quite low? So you've got no causal arguments as to why there's a sustainability problem.
Okay, well, let's just see. What we'll do is we'll go back after the break, come back after the break, and you will tackle the issue around debt serviceability, because that's where he's disagreeing with you.
Sure.
The debt level's there, but he's saying the ability for us to service the debt is a lot better than you, and we'll kick off on that after the break.
Sure.
We'll be back in a moment. As you can see, it's a very interesting topic. We're back with the property punch-up of the century, starring John Adams on my right and Christopher Joye on my left. And last time we were talking, Chris made the point that while the debt's high, he's not as concerned about the serviceability issue, and this is what John Adams wants to respond to now. John, take it away.
Thank you. Okay, so the first point to make is, in the history of humanity, you have never seen a debt bubble this big that lasts. There is no empirical evidence that Chris can cite that a debt bubble this big is sustainable, number one. Number two is, if we can bring up the graph in terms of Ireland, in terms of will Australia be like Ireland?
Yeah.
Okay, so basically now, what drives
What's the yellow line in this one?
Yeah, so the yellow line is annualised credit growth into housing. So this is from RBA data. So what drives up house prices is the growth of debt.
Yeah.
Now, why was Steve Keen wrong? Was because he thought that, so at the beginning of the graph, when the growth collapsed because of the GFC, Steve thought that the government couldn't get the rate of growth back up, and he thought that...
We argued about this on my program many times.
Exactly. Yep. So we had at the first point one set of intervention where it went down and went back up.
Yep.
Then we had with a stimulus package and a massive cut in interest rate. Then when it fell down to 4.4% annualised growth,
around what, 13, 14?
It was January 2013.
Yep.
We had another massive set of interventions. We had the increase, a massive increase, cut rates.
Yep.
We had a massive increase in the amount of investors in the market.
Yep.
We had a massive increase in investor-only loans, and we had, because of the Royal Commission, systemic mortgage fraud. The amount of loans.
Lots of things were going wrong to pump up the debt level.
Exactly.
Okay.
And just to give you an example, Sydney, new loans in 2017, they were lending at 10 to 12 times income, and the worst it ever got in Ireland was only 6 to 7 times. So twice as bad as the loan to income ratio. Now, the thing is, so here's the thing. If you look at the end of the chart, credit growth to housing collapsed once the Royal Commission was announced. Why? Because the banks got scared about criminal prosecution, and they basically said we need to play within the framework of responsible lending. So the RBA will say it's about demand. There is demand now, but it was initially supply. So that's why it's falling. Now, what I'm saying about this is on a whole set of metrics, in some cases our debt levels are worse than Ireland. In some cases, Ireland was worse than us. But having spoken to experts in Ireland who predicted the housing crisis and having studied the depression in 1892, if this number, this credit growth to housing, if this continues to fall and policymakers can't stabilise this number, what you would see is house prices continue to fall, more households in negative equity, and that's when you get panic.
Yeah, and for the first time I saw some tweets from you, or it might have been Martin. The point I made was, you could be right if we go into a recession, and that's kind of what you're implying, that if you can't...
No. What I'm saying is that this causes the recession.
Yes, I know that.
Yeah. So
I just want to clarify for his response.
So when you have a bubble, there's two ways to pop it. Either the growth in the growth of the bubble slows.
Yeah. So the air comes out of the balloon rather than pricking it.
No. The prick is rising interest rates. Right. We don't have that. And you had a guest on last week, BIS Economics, Oxford Economics, that talked about rising interest rates. But the other way, because this is what happened in 1892, Barings Bank in London went belly up. That resulted in a massive contraction of credit coming into Australia from the UK, and then that led to prices deflating, and then you get panic. So this will happen in Ireland. If the banks panic and they continue to contract credit, then households panic because they're in negative equity. Then you start to see a massive contraction.
But you haven't.
You get a massive contraction in consumption, and the job loss. So the shock that the serviceability comes from a rise in unemployment, where construction, real estate, and retail. Why? Because any time you have a bubble, you get a growth in the real. You get an attraction of real resources.
Okay, so we understand the links now.
Okay, So I don't think he's provided any explanations of what the causal relationship is between interest rates, income, and credit growth. He's saying that credit growth is falling and house prices are declining. Ipso facto, we need to have a recession. We need to have a cataclysmic recession. I don't think he's presented any evidence for that. But let me talk to Ireland. Which is an example you cited. Australia's net government debt to GDP ratio is 1/3 the Irish net government debt to GDP ratio. So we have 19% net government debt to GDP.
So you're saying our government is in a better position to respond?
I think there's a few key points. Firstly, we're carrying 19% net government debt to GDP compared to 60% in Ireland, or over 80% in the United States. The second point is the Irish economy was basically a fraud. Ireland set up a tax haven. A quarter of all Irish economic growth was driven by multinational company royalty payments from their Irish subsidiaries to their offshore entities, right? The problem is the rest of the world has now sought to close those loopholes, right? The US is attacking Ireland, EU is attacking Ireland, and looking to remove that competitive advantage that they furnish themselves with tax rates. They didn't actually have any underlying intrinsic edge. You look at Australia, on the other hand, Australia has run population growth since 2008 that's been 2.2 times faster than Ireland's. Australia is the biggest exporter of iron ore, coal and liquefied natural gas in the world. We're a massive global exporter of tourism and education.
What are our banks like compared to Irish banks?
Wait a second. We have fundamental competitive advantages. More importantly, the Australian government's running a budget surplus. In February, we ran an $11 billion surplus in the month. The budget's in balance. So I think that the two economies are oil and water. It's like Steve Keen used to say in 2008, we were just like Japan. The problem is the Japanese population growth rate had been negative since 2000. Their population was going to shrink 25% by 2050. Our population was forecast at the time to increase by 60% by 2050. On the level of household debt, John's made a big deal about this. The RBA analysis shows our household debt level is high. I've always argued the same point. Here I agree with John. It's in the top quartile of global peers. The Netherlands and Norway have higher household debt to income ratios, but there's a key difference in Australia. In Australia, we have two things. We have a very high home ownership rate, around 70%. But crucially, the rental stock in Australia is also owned by households. Around the rest of the world, it's often owned by institutions, right? So households have elected to put that debt on their balance sheets, whereas in other countries, other forms of debt are being put on household balance sheets. So I don't think they're legitimate comparisons. I would be worried if there was a shock to incomes or a shock to interest rates. If John was going to tell us next year the Chinese economy is going to recession, the global economy is going to recession, 100% we could get a 30% fall in house prices. But our central case is that the global economy will continue around its current trend rate. We predicted 5 years ago that the US unemployment rate would fall below 4%. We've consistently predicted that US growth would surprise on the upside. US growth has been running around 3%. Trend is around 2%. It's the biggest economy in the world. Australian growth since 2013 has been running at about 2.6%. So we've actually got pretty strong underlying fundamental economic conditions. I think it's predicated on President Trump needs to do a trade deal with Xi. We do need a benign Brexit outcome. But for the foreseeable future, we stand behind our, thus far empirically correct forecasts of a 10 to 15% drawdown in house prices. I don't see any kind of cataclysmic shock. Now, one other point I want to make. The RBA just published a research paper showing that...
it was a crap paper. Absolute
let me finish.
It was dodgy research.
Let me finish.
So the
RBA just published a research paper that showed that the 50% jump in house prices in Australia between 2015 and 2017 was largely driven by the 3 percentage point reduction in the cash rate from 4.5% to 1.5%. The analysis shows that a 1 percentage point reduction in the cash rate. So if we went from 1.5% to 0.5%, would actually increase interest rates by about 28%. So a 50 basis point reduction would increase interest rates by house prices by 14%. So I think we have, if there was some sort of economic downturn, the fiscal policy is in balance. We're running basically one of the few countries in the world to be running a budget surplus or thereabouts. We've got bugger all net government debt, right? Very little net government debt, and we actually have ample monetary policy ammunition. The RBA can cut the cash rate to zero. We're not at the lower bound, and it can also engage in quantitative easing, so it can buy assets to reduce the cost of capital. So I've been bearish on housing since 2017. We were the first mainstream analysts in Australia to call a 10% drawdown in house prices. No one else had that view at that time, and we got the boom right. We weren't these perennially negative perma bears, right? We've got the cycle correct all the way through the cycle.
The cycle's a 20-year cycle. It is not a 4-year cycle. You're missing the point. It's a 20-year cycle, and this is, again, the biggest debt bubble in the history of the country.
Okay, we're going to a break, and when we come back, John, you'll put forward your case for being right, the main reasons why you think you're right, and Chris, you'll have your final wrap-up as well.
Sure.
Right? Okay. Coming up after the break, as I said, we'll get the final wrap-up of why John and Chris think they're right. Welcome back to the property punch-up of the century, and it's getting close to blows here. So let's finish off with John Adams. He'll sum up the main reasons why he thinks he's right, and then we'll go to Chris for his wrap-up as well. So John, take it away.
Thank you very much. 5,000 years of history. Like every debt bubble, it always explodes. This is the biggest debt bubble since 1788. domestically. At the same time, we've got the biggest debt bubble in the history of the world. There is no empirical evidence to say that all of this is sustainable. To the points that Chris made before the break, what did he say? We have a different economy to Ireland. Yes, we do. We have some differences, but debt is debt. There is a bubble, and this Reserve Bank paper. I mean, I hear this consistently right across the country. We are special. We are unique. It will not happen to us, even though it happens to other countries. We will avoid the crisis. That's why we have this big bubble. Mass denial. People have borrowed to the hilt. Unsustainable. Now, Chris talked about government debt. Now, yes, we can intervene to stabilise the housing market, but that comes at a cost. And I've spoken to numerous politicians about this. The cost is the confidence in the currency, confidence in the dollar, because we have record foreign debt. So if we do QE, if we do zero interest rates, if we do massive fiscal stimulus, like Chris said, can we avoid a massive collapse in the property market? Yes, we can. But at some point soon, and I have this book written by 2 economists in Melbourne, they have said we are headed towards a balance of payments crisis. Foreign debt is totally out of control. And if we follow Chris's prescription, the dollar will crash 30 to 40%, just like with Turkey last year, just like with South Korea in 1997, when the foreign creditors say, we know you can't pay your foreign debt.
Okay, and that's Peter Brain and Ian Manning, by the way, if people are interested in their book, Credit Code Red. All right, Chris.
Listen, I've explained all of this on our Complexity Premier podcast, but bottom line is John is yet another expert in search of a headline who won't receive the gratification he desperately desires. He says that debt levels are at 5,000-year highs. Okay.
No, I didn't. Yeah.
Yes, you did say that.
Yeah.
You said that repeatedly. Stop interrupting.
Yeah.
Okay. You say debt levels are at 5,000-year highs. The problem for John is that mortgage rates are also at 5,000-year lows, according to Merrill Lynch, right? So debt serviceability at this point in time is perfectly fine. When we take the median house price in Australia in 1980 and we gross it up by household incomes and we gross it up by the change in mortgage rates, we actually find that house prices today are 3% undervalued. Now that is again predicated on the assumption the RBA cash rate stays at 1.5% forever. I don't personally buy that case. I think it needs to rise. I think it needs to normalise. I think where John and I agree is, potentially we're in an inflationary cycle. We've seen, again, 5 years ago we said US wage growth is going back to pre-GFC peaks. US wages growth is back at pre-GFC peaks. Very few people globally had that view at that time. Now, if we move into an inflationary cycle and if we get a big long-term increase in interest rates, I'm with John, right? Debt won't be sustainable, but for the foreseeable future, we are nowhere near that case. A final point, the Aussie mortgage default rate today is about 0.7%. The average default rate in Ireland between 2000 and today has been about 11%, right? The mortgage default rate between 2000 and today has been more than 20 times higher than the Aussie mortgage default rate. Australia historically has had the highest mortgage rates in the world, very high, lofty mortgage rates. So notwithstanding that home loan rates were at about 9% in 2008, in the GFC, our mortgage default rate only rose to about 0.8%. In Ireland, it jumped up to over 20%. So completely different case studies, different circumstances. I am worried about the level of debt. I have been worried about housing valuations. I wrote in the AFR 1 million times, housing's overvalued and it needed to correct. I thought it was somewhere between 15 and 25% overvalued. Yeah. Our call in terms of prices has been a 10 to 15% drawdown. That's been proven exactly right. And I think we're going to go through a period where housing is going to be a pretty low growth asset class.
Is John going to be more right if we go into a serious recession?
100%.
Okay, so that's going
otherwise TKO.
Yeah, so that's going to be a typical reason to worry if we head towards recession.
Yeah, 100%. All bets are off if we go into a global recession. Yeah, we're going to have a big problem.
But the point is, we can pancake independent of the global shock. How? If credit growth for housing continues to fall and people panic and we see a rise in unemployment in construction, retail and in terms of real estate, that can be sufficient to lead to the mortgage default rates that...
Can I say just...
One quick one, 10 seconds.
All these experts in search of a headline have said that we're going to have this huge credit crunch. Year-on-year credit growth, housing credit growth is actually positive 5%. We haven't had the credit crunch. It's decelerated dramatically. It's at historical low rates. I actually think the banks are going to start loosening credit. The RBA is encouraging them to do that. I think the banks are going to start dropping mortgage rates. Their funding costs are coming right down. The bank bill swap rate has dropped from 2.1% to 1.8%. Funding costs for the major banks have dropped from about 1.15% 0.5% above bank bills to about 0.9% above bank bills. That will be passed on to consumers as they compete against non-banks. The non-banks are storming the trenches, and so I think we'll actually see an improvement in credit growth.
Okay, guys, we are out of time. It's an exhilarating debate. It's going to be interesting to see who's right. Now, as I've said to you, I prefer him to be right because I don't want your scenario, John.
Either do I.
It's a particularly scary one. There's Steve King used to say to me on my show, I used to say to him, I hope you're wrong, and Steve would often finish off by saying, yes, I hope I'm wrong as well. So let's hope you're wrong. Okay, that's the show. Thanks for joining us. And remember, the Switzer Strategy Days are coming up in late April and early May. We're in Sydney, Melbourne and Brisbane. Go to www.switzerevents.com.au. I'm Peter Switzer. Thanks for joining us. And it's the first program where I really haven't spoken much because these two guys took over the show. Thanks very much.